B2 Financial Management, and our next module is Financial Valuation Methods Part 2. What exactly do we have in this module? Option pricing models, just discussion, no computation at all, because option valuation is one of the most difficult areas in financial management. So you are not going to be tortured with this calculation area, just little knowledge of option valuation. That's all. Then we'll be discussing valuing debt instruments. How do we value bonds? Valuing tangible assets like property, plant, and equipment. And how do we value intangible assets like patents, licenses, and finally, valuation using accounting estimates. So these are the 5 subtopics within the module 7, Financial Valuation Methods Part 2. Let us first discuss option pricing models and briefly discuss what an option is. What are options? I'm sure all of you have some basic knowledge of options. We have discussed in our earlier studies. We have discussed it in our section B1. Options are of 2 types, call options and put options. Call options give you the right to buy something at a certain price, and put options give you the right to sell something, some underlying at a certain price in the future. So these options are purchased with an intention to hedge yourself against volatility in price movement, to protect yourself against the movement of prices. You want to protect yourself against adverse price movements. So that's quite a detailed topic discussed earlier. We will be doing only to that extent that is required as per the CPA blueprint. So options, call and put options, they are bought for reducing risk. Just keep that in mind. Now the point is valuation. Our topic is the valuation of these instruments, of these options. There are 2 models used in option valuation. One is Black-Scholes, other is the binomial model. We'll discuss first Black-Scholes model. Black-Scholes model is considered to be one of the most complex valuation model for option calculations. Those who developed this model, Black-Scholes, they were professors in a university. They were awarded Nobel Prize for this development, for this model. Nobel Prize, which is considered to be the highest prize for any effort, any human endeavor. As I told you, option valuation is an extremely complex domain. This is clearly beyond the scope of your CMA and CPA syllabus. What you need to know, that there are certain inputs to the Black-Scholes model. This is the actual form of Black-Scholes model which we use in ACCA and CA, but luckily nothing like that in CMA or CPA. So as I said, we will be just discussing the inputs into the model. Current price, this is reflected by K in this formula. Exercise price, also called the strike price. Current price of the stock. Current price of the foreign exchange. Current price of a certain commodity. Anything. Could be, options could be written on anything. On bonds, on shares, on foreign exchange. So the current price is K. Exercise price for call and put option is the price at which you can exercise the option. It is represented by ST, that is the strike price. Risk-free rate is represented by R in this formula. Time to expiry is the time for which the option is good. After that it lapses. And the last one is the standard deviation, which is given right here. So these are the inputs. So these are the 5 inputs to the Black-Scholes model. The current price of the underlying stock, foreign exchange or commodity. Exercise price for call and put option is the price at which you can exercise the call or put option. Risk-free rate, time to expiry, 2 months, 3 months, what is the time covered under the put or call option. And standard deviation is a measure of volatility, right? Just remember, these are the 5 inputs. Now, there are certain assumptions for this model which make this model work. Without these options, the model fails. And I'm telling you again, you don't have to apply this model anywhere. You just need to know what are the inputs and what are the assumptions and what are its limitations. Khalas, nothing else. So first assumption is that the stock price, K, this stock price can behave erratically. Price can go up and down during the period of the what you call the time to expiry of this option, call option or put option. First. Second, the risk-free rate used here are, this risk-free rate is assumed to be constant over the option life. If the option is for 3 months, this R risk-free rate will stay the same for 3 months. Then the third assumption is there are no costs, there are no taxes, no transaction cost, no taxes. You can challenge this assumption because whenever we make a stock transaction, there is a cost called commission. Then the fourth assumption is that there are no dividends. Again, you can challenge, how can you have a common stock that doesn't pay dividends forever? So no dividend means there is no dividend for the stock during the period of the option, call or put option. But despite that, even the model assumes that there is no dividend, but still this model can be modified. The model can be modified to accommodate dividends. So at least only this part can be removed. You can bring the impact of dividend in the formula. That's what you can do in the Black-Scholes model. Then finally, the last very important assumption, the Black-Scholes model is applicable only on European options. Now, what's the difference between European and American options? European options can only be exercised at expiry date. Let's say if the term of the call or put option is 3 months, then European option can only be exercised at the end of the 3rd month, right? Whereas American options, they can be exercised at any time between the start and the end of the 3rd month. That's a very important distinction. European options can only be exercised at maturity, whereas American options can be exercised anywhere between 0 and the maturity, now till the time to maturity, right? Now, the point here to learn is that Black-Scholes model is developed or was developed keeping in mind the European options. This model is applicable only for European options. Important point. Now, there are some limitations also. The first limitation of this model, what we are doing, remember, we are doing the valuation methods. First, we are learning how to value options, complex financial derivatives. Now, first limitation is that the value these models will give for call and put options, they will deviate from the real prices of call and put option. Let's say if I've calculated the call option to be $5.3, when I purchase this option, I may have to pay $7, or maybe I have to pay $9, right? Or maybe $4. So the model is not very accurate. Then the second limitation is that it totally ignores cost, but this is not true. There are costs involved when we engage in some transaction like this. You can't avoid taxes, you can't avoid transaction costs. They're always there. Then the third limitation is that these call and put options valued under the Black-Scholes model, they will tend to underestimate the extreme price movements. If the price goes too up, if the price goes too fall, these extremes are underestimated. In other words, the model fails wherever there is an extreme price movement up or down, right? Then the third one, that this model is only applicable for European option. It does not incorporate the American style options. Then why this model is so famous? Why Black-Scholes, they were awarded with Nobel Prize? The reason being, before this model, there was no way for valuing call or put option. At least these two gentlemen, may they rest in peace, at least they brought this model. At least they gave us some idea how to value the call and put option. Before that, there was just guesswork, but at least we have some modifications, some adjustments can be made to value the call and put option. Now, the next version we have is the binomial model, also called the Cox-Ross-Rubinstein model. This is different from Black-Scholes model in a way that this model has certain assumptions. I'll explain first. There are certain assumptions that this model works only when the markets are efficient. Perfectly efficient market means the information is instantly reflected in the stock price. Second assumption for this model is that the stock price move up and stock price move down will occur on specific points in time. Now, this is again a questionable assumption. How do we know exactly when and by how much the price will fall or the price will rise? See, it's quite a complex assumption. Okay, so there are certain benefits also to this. American style options which could not be valued using Black-Scholes, using the binomial model or Cox-Ross-Rubinstein model, we can value American style options. We don't need to modify for a stock that pays dividend. This is good. We don't have to modify. But remember, Black-Scholes models required modification, but this model, binomial model, it requires no modification to incorporate those stocks that pay dividend, right? So there are certain benefits we have discussed. There are these assumptions that we have taken, they can be represented as limitations also. These assumptions are basically the limitations because not all markets are efficient. At the same time, price up and price down, they cannot occur at a certain points in time. We can never be so sure about this. So you just need to know only to that extent as per your CPA syllabus blueprint. Do not go any further, not needed. The next area is valuing debt instruments. How do we value debt? Bonds. How are they valued? Let's discuss. How do we value bonds? What's the value of bond? Value of a bond, the price of the bond, is equal to the present value of the interest payments under the bond, present value of interest, plus present value of the original principal. Let's say I've issued a bond with the par of $1,000 that pays interest at the rate of 6%, which means, and let's say this bond has a time to maturity of 5 years, means the interest payment in the first 5 years will be 60 in year 1, 60 year 2, 60, 60, 60. And at the end of the term, the $1,000 is to be paid to the bondholders. So if you bring these 560 payments in the present term, this is called the present value of interest payments. And this $1,000 single payment, this is called present value of principal. Adding these two up will give you the value of bond. Now the question most of you should ask, or most of you, the area that most of you get confused, 6% is the rate at which we pay the interest. This is called the coupon rate, or sometimes it's called the stated rate. Remember. Coupon rate or stated rate is the rate used to calculate the interest payment. But when we discount the bonds, we need a rate for discounting also. Remember, the rate we use for discounting is the rate prevalent in the market at the date of issuance. Let's say when I issued this bond, at that point in time, the similar bonds were offering a rate of maybe 9%. So I should use this 9% for discounting. Or maybe when I issued these bonds at 6%, at that time, these similar bonds were available in the market at 4%. So remember, coupon rate or stated rate is used to calculate the interest payments. The market rate prevalent at the date of issuance is the rate we use to discount. This is important. I will explain this with the help of some computations. And yes, this is very important. Impact of interest rates on bond value. Let's say a bond that is currently trading at $1,060 and paying a coupon rate of, let's say 7%. If the market rate goes up to 10%, the bond price will fall. Or if the market rate goes down, the bond price will go up to maybe 1,080. So remember, there is an inverse relationship between the interest rate prevalent in the market now and the bond value. They move in the opposite direction. When the interest rates go up, bond values fall. When the interest rates go down, the bond value go up, right? And the reason is very simple. When the interest rates go up, then this bond is paying just 7%. Why people will not look for something that is paying more return? So the bond price will fall. But when the market interest rates fall, these bonds will become attractive because they are still paying high returns, so their price will go up. So this is how you can conceptualize the idea. Now let me explain how the market rate at the date of issuance and the stated rate are linked. Let us take an example. Let's say we have a bond that has a 5 years term. We are offering 5% return. This is called the stated rate. But at that time when we issued the bond, the market rate was 3%. My rate is 5%, market rate is 3%. Since my rate is more than the market rate, the stated rate is higher than the market rate at the date of issuance, the bond is called a premium bond, a bond that is a par value of $1,000. Since it is offering such a lovely return of 5%, the bond will sell at 1,091.59. This is called the premium bond because a $1,000 par bond is being sold at 1,091 because people are willing to pay more price because the rate this bond is offering is more than the prevalent market rate at the date of issue. How did I get this number? Let me show you. Let us calculate this value. Is it really so? First of all, you need to use these TVM functions. N represent the term of the bond, I interest rate per period, PV is the present value of the bond which we want to calculate, PMT is the regular interest payments, and FE is the future value of the face value. So let us plug in the numbers. Our bond is a 5 years bond. Press 5 is N. You need to press 5 first and N later. The interest rate that is prevalent in the market, remember, this is what you should use as for discounting. Remember, I upon Y, that is interest rate per period, is the effective market rate, 3%. Press 3, press interest rate per period. Then next is the present value. That's what we want to calculate, the value of the bond. PMT is the regular interest payments. How much interest are you going to pay? Since the stated rate is 5%, 5% of 1,000 will give you 50. So you are going to pay 50 every year. So you will write 50, write negative because it's an outflow for you. 50 negative is an outflow, right? So press negative 50 and it's PMT. And after, when the 5 years are over, you're going to pay back $1,000, 1000. This is negative. That's the face value, the future value. We have plugged in all. Now press CPT, that's compute, and press present value. This is 1091.59. That's the value you will receive now, plus. So if you're going to pay $50 every year, you will pay $1,000 at the end of the bond's maturity, negative 50, negative 1,000. So what you will receive is 1,091. Since your rate is more than the market rate, so your bond sells at a premium. This 91.59 is the premium on bond issue, right? So remember, when your offered rate is more than the market rate, bond sells at a premium. Let us now go for the next one. Now in this case, your stated rate is less than the market rate. Let's say the term of the bond is 5 years. Now you're offering just 2% return, whereas the rate at the date of issuance is 3%. The market rate is 3%. Your offered rate is less, market rate is more. So gentlemen, definitely your bond will get you less money. This is called discount bond. Par is 1,000, but you will only get 954 because you are offering less rate than the market. Let us see if this is proved by the financial calculator. The term of the bond is 5 years. Press 5N. Interest rate that you're going to pay is 2% for 1,000 is 20. Let's press the interest rate first. Remember, the discounting rate is 3%, but the interest payment is at 2%. So 3 is the interest rate per period. 3 is the interest rate per period. Then the interest payment are 2% of 1,000, that is 20. 20, negative 1. Okay, and then we have a 1,000 par. This will represent the final redemption value of the bond that you will repay. Negative, that is the future value or face value. Now, we need to calculate the present value, the value of the bond at which it will be issued. Compute PV. 954.20. That's what you will receive because you're offering less rate than the market rate. Now let's go for the third case. Now in the third case, your stated rate is same as the market rate. Term is 5 years, stated rate 3%, market rate 3%. This is the par bond. A bond that has a par of 1,000 will get you 1,000 because the stated rate and market rate are the same. Let me show you by first clearing the TVM inputs. Term 5 years, press 5N. Interest rate per period, always remember, market rate is 3. PMT is going to be 3% of 1,000, that's 30. 30 negative is going to be the regular payments. And the future value, face value is 1,000 negative, 1,000 negative. Press CPT PV, exact 1,000. So when your stated rate and the market rate are the same, bond will simply get you the par. Okay, now we have a question. Debt instruments, valuation. A $1,000 face value bond maturing in 3 years. That's the face value, the future value, the redemption value. Term N, that is 3. Annual interest rate, that is 4. That is the coupon rate, 4%. And finally, calculate the bond price if the market rate at the time of issuance was 5%. So market rate, which will be used for discounting, is 5%. Now let's say if you don't want to use the financial calculator, how you're going to find the value of the bond. So this is what you can do. The value of the bond, or the present value, is equal to how many interest payments are going to be there. It's a 3 years bond. Remember, the stated rate is 4%. 4% of 1,000, you're going to make interest payment of 40 in the first year, 40 in the second year, 40 in the third year, right? 40, 40, 40. And remember, the last year payment would also include the principal. So what you're going to do, if you want to calculate the present value, divide it with the discount rate 5%, 1.05. This will calculate the present value of 40. 1.05 squared. This will calculate the present value of 40. That's the second year cash flow. And this one, 1040 with 1.05 cube. This will give you the present value of 1040. So adding all these up, if you can calculate by pausing the video, you can calculate the price of the bond. But let us do it in a much faster way using the financial calculator. Okay, gentlemen, so we have a bond that has a term of 3 years. 3 is the term of the bond. Interest rate per period, that is for discounting, is the market rate 5%. The payment that you're making every period is 40 negative, remember. And the face value is 1,000. Compute present value, it's 972. 972 is the value of the bond using the financial calculator. You will get somewhat similar answer when you discount these numbers. You can pause the video and you can do it yourself, and you will see the results are the same. Now the next area we have is the valuing tangible assets. Okay. Tangible assets, when you say tangible assets, means you're talking about the assets that you can touch, like your plant, your furniture, vehicles, properties, so on and so forth. Many assets we have that are tangible, that exist in physical form. How do we value them? There are certain methods. First is the cost method. Original historical cost method. Let's say when we acquired a certain asset, the original historical cost, including all the installation, testing, etc., was $100,000. And this asset is expected to last 5 years. So what we do, every year we charge depreciation, which is accumulated in an account called the accumulated depreciation. Original cost minus accumulated depreciation gives you what you call the net book value or the carrying value. We know this well. We are accountants, professional accountant. That's our domain. We know that. This is the original historical cost. This is the depreciation so far charged. Net of this gives you the carrying value or the net book value. So this is the first method we use for valuing our property, plant and equipment. The second method we use is called the market value method. In the market value methods, we have two subcategories. The first is called the replacement cost. What is replacement cost? Replacement cost is the cost that you will have to pay if you want to replace the asset. Replace the asset that is currently in use. Or second that you could use is called the NRV, net realizable value. What is it? Let's say the asset we are currently using, it can be sold for $50,000, but it will cost us $5,000 to remove it and to sell it. So NRV is 45,000. So now you have two options. You can use the replacement cost method or the NRV, and both are these based on the market. That's why they're called the market value method. Then the third one we have is called the appraisal method. Appraisal methods mean we will have certain qualified appraisers who will value the property, plant and equipment. So the value they assign, that could be used as the reporting amount on our balance sheet. And the fourth one, which is rarely used, is the liquidation value. Means if the asset is sold now at very point in time, right now, excluding any disposal cost, the liquidation value means the disposal value of the asset as so these four can be used for different assets shown in the property, plant and equipment. Let us do this as an example illustration. A company is assessing the value of the equipment at its headquarters using the market value method. The company determines that it would cost $6.2 million today to replace all of its equipment. So clearly it's replacement cost. The company also determines that selling its equipment in the marketplace would generate $5.9 million after accounting for selling and disposal. This is NRV. This is the replacement cost. Either value may be used as a reasonable proxy for the market value. Right? Now, let's move on to the next category, valuing intangible assets. When we say intangible assets, mean these are the assets that do not have the physical substance. They do not exist physically. What kind of assets could they be? Of course, the assets that don't have any physical form are like patents, copyrights, trademarks, licenses. These are called the intangible assets. Now, how do we value? There are certain methods. First is the market approach. Market approach means, let's say if I have a certain intangible like a license, for example. If it could be sold at $10,000 right now, this could be its valuation basis. So this is called the market value-based approach, or the market approach in which the intangible can be sold easily in the market, in an active market. So this is the preferred approach for valuing an intangible. Then the next one we have is the income approach. This is a good approach. In income approach, what we do, let's say this asset will last 5 years and it will generate certain cash flows in these 5 years. If we can bring these future cash flows into the present value using a certain rate that incorporate specific risks related to this asset, discounting these future cash flows at a specific risk-adjusted rate will give me the value that I can show my asset for. This is called the income approach. The amount this asset will generate, discounting these cash flows at a certain risk-adjusted rate, will bring me the value of this intangible. This is the second approach we have. And the third approach, which is quite apparent, we know this cost approach means the cost that we incur to acquire that asset. If there is no income available, if there is no market approach, if the asset doesn't have any market price, then we can use the cost approach, right? The cost that we incurred to acquire that asset. There are further 2 iterations to cost approach. One is called the replacement cost, the cost at which this asset can be replaced, and second is called the reproduction cost. Reproduction cost means if you build this intangible again, what will be the cost you need to pay? This is the third approach. Let us do some examples to explain the idea. Okay, this is the one that explains the market approach. A company has patent in its intangible portfolio that is looking to monetize. In looking at a recent transaction for comparable patent sales, the company discovers 4 within the last couple of years. There are 4 certain prices of similar patents. The company will look to assign a value within the range of 15.1, which is the lowest, up to 18.5, which is the largest, highest, right? So when 2 extremes are available, what you should do, you should go for the median, the middle number. Now these 2 extremes are rejected. Now we have these two middle values, 16.2 million and 16.8 million. So the preferred approach is, the market approach, to take the median. Add these 2 up, 16.2 plus 16.8, you would get 33 divided with 2, you get a middle number called the median, that is 16.5 million. That's it, right? So this number is the median number, and this is what you can use in the market-based approach. Income approach already discussed. This is an example of income approach. Eagle Road Enterprises owns a patent that is expected to generate 4 million each year for the next 10 years. This is the income generated by this asset. We can discount these 4 million cash flows by multiplying this with the annuity factor. I told you when the cash flows are similar, we can use an annuity factor. We discussed it at the very start of this lecture. So we can multiply 4 million every year cash flow with the annuity factor at a certain rate. Maybe it's not given here, 5.5%. For 10 years, this factor is given. It will be given to you in your MCQs. You just have to use this rate and multiply with the cash flows, and this will give you the present value of your future income. So you can value your intangible at this approach, at this price. Now this is the last one, the cost approach. Alpine Incorporated looks to establish a value for the copyrights in its intangible assets portfolio. Using a valuation date of today, Alpine determines the following values for costs, which you call the reproduction cost, Adding up all these costs will give you the value of the copyright. You need to spend this much labor, material, overheads, legal under fee, development costs, production costs, opportunity costs. Combining these all gives you a total of 112. This could be used as, this is the term exactly we discussed a little while ago, as a reproduction cost. So this will give you the total value of this intangible. Now we have the last subtopic, valuation using accounting estimates. We have these specific items on financial statements, and we have some specific valuation methods for it. I'm sure you remember account receivables are reported at NRV, that is the account receivables gross number divided by the balance of allowance for uncollectible accounts. I'm sure you know this. That's an estimation of bad debts. How do we value inventory? Remember, if the inventory is valued at LIFO or retail method, for this we have a method called the LCM rule, discussed earlier in a separate reading. Then for all the other bases, FIFO, weighted average, we have a method called the NRV method. Remember, LIFO and RM retail method, LCM rule is only applicable in the US GAAP, and I'm sure you also know IFRS does not allow LIFO. Makes sense. Then we have fixed assets. Of course, we know how to value fixed assets. Fixed assets are reported at original historical cost, and we keep on accumulating the depreciation in a separate account called the accumulated depreciation, and we report it at the net book value, also called the carrying value. That's what we discussed. Then contingent liabilities. Contingent liabilities are the future obligations which may or may not materialize depending upon some uncertain future situation. So we need to report them on most probable basis. So this is an area that is discussed in much more detail in your FAR. So we will discuss it there and then. Okay. Now there are certain bases we use for accounting estimates. First is the historical information, means the assets that we acquired at a certain price that will form the basis of your long-lived assets. Or if we, let's say if you are calculating allowance for your uncollectible accounts, you will use the historical information regarding the pattern of your bad debts. Like every year your bad debts go within the range to 3 to 4%. So next year, whenever you calculate the allowance for uncollectible accounts, so you should use a percentage somewhere near this. So you use historical information to establish your accounting estimates, right? Pattern of bad debts. You also use the market information. Market information for what? To apply the LCM rule, which I'm sure you know. Under the LIFO and retail method, we use LCM rule. And of course, it takes into account the market information. And when you use the NRV method for all other valuation methods, NRV, of course, you know, it's the final selling price minus the cost of sale and cost of completion. So they incorporate the market information for, especially for valuing your inventory. Then expected usage. Yes, we use this information for calculating depreciation. How many years the asset will last? What would be the pattern of consumption? So this is very useful for establishing the depreciation method or depreciation percentage. Then finally, the expert estimate. We are not engineers. Accountants are not engineers. We are not Mohandis, right? We are accountants. Mudirul Mali. So we have just knowledge of accounting. We do not know how long an asset will last. So sometimes we may have to get experts estimate. Let's say I'm working in an oil refinery business, or let's say I have oil wells where oil is extracted from the earth's surface. How much oil is there inside the earth's surface under my ownership? This is I can't do as a accountant. For this, you have to acquire the knowledge of geologists. They will use some machinery, some ground sonars, and this will help them assess the volume of the oil available, and that's the estimate we will show on our financial statements. So you use historical information for bad debts, you use market information for LCM or NRV, you use expected usage for calculating depreciation, and sometimes you need to take in the experts as well. And why would you do that? Because at the end of the year, auditor will come. Muhasib, the Kanuni Muhasib, the one who is legal auditor, will come and audit your financial statements. So you need to prove them. You need to show them documentations. You need to prove your assumptions were right. You need to show them calculations, because auditor will scrutinize, auditor will check the valuations, your estimates, because this is how management plays. They may manipulate the numbers so as to artificially inflate the profits. So you need to satisfy the auditor, and that's why we need to have proper documentation. Experts' reports must be verified. We need to have justifiable assumptions, and we need to be able to support the numbers through calculations. So gentlemen, that ends your M7 Financial Valuation Methods Part 2.